Hey everybody, welcome to Trading Capital's Daily Analysis video. I'm your head market analyst here, Curtis Gavin. Jumping into the charts on this October 19th. First off, let's discuss the S&P 500. It did finish slightly down today, down by 0.71%, which is pretty surprising considering the powerful move on the Netflix earnings. So it just goes to show you that the markets really, you can't really take anything for granted. I was pretty confident that we would see a positive day after that massive pop on Netflix earnings, but it just shows you the power of the other bigger cap tech stocks. And certainly why the markets finished lower, well, it was all the US dollar. But looking at the S&P 500 here, the interesting thing I want to point out, and I know we did sell a bunch of our longs, but we do have a few big day trade positions that we left out there. Even the day trading today was extremely difficult. This might be due to the fact that options expiration is on Friday. It tends to overshoot technical levels, and we've actually been caught in a couple day trades where we're currently losing money on the positions, but I'm comfortable holding them overnight just due to the fact that, well, I'm going to discuss the couple reasons why I'm comfortable holding overnight. Being the fact that they're completely oversold, the markets are still holding a little bit of a bullish consolidation pattern here. And surprisingly though, the correlation that I'm picking up is the DXY. Obviously the DXY, the dollar, had another positive day. And it just goes to show that we did touch base on the dollar. The trend was that it was bouncing off of this 25-day moving average. You can see it bounced here. You can see it bounced pretty much tagged over here again. And you finally got that bounce again on the dollar. So very interesting to keep that trend continuing. Now you have hit resistance on the dollar, and let me just flip to the 4-hour chart to show you what I'm seeing. So you've certainly hit some downside resistance trend line over here, connecting a major pivot to this intersection blow off top wick, another major pivot zone. And the beautiful thing is that we got a little bit of this reversal doji signal on the 4-hour chart, and despite pushing up very hard late in the day into the afternoon session, you weren't able to close above that wick, so you could not confirm the continued upside move, which is very important because I think we should see a little bit more downside. Now, the interesting thing about the dollars, if we flip back to the daily chart, you can obviously see that it had a pretty big, powerful day today, down up 0.81%. Now, what is really intriguing to me, and in this way, the dollar is showing relative weakness despite the fact that the dollar was up today, it is showing relative weakness. And why I say it's showing relative weakness, if you simply look at the yields, basically all of the yields have been pretty much breaking out. You can see that the 10-year yield here has now hit this upsloping parallel channel. So you are into major resistance. You're in an extended move once again, and I do think we should see a pullback in the yields. Now, we have not confirmed a breakout. In the event that yields close tomorrow higher than today's closing high, that is yet again another technical breakout, and the next upside target on yields would be this 4.52 level. But if we look at the yield chart, the 10-year yield, when you have a move of 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 weeks in a row into a major resistance, a parallel channel of resistance connecting a major pivot here, major pivot zone over here, major pivot over here, this should act as some resistance in the near term for a potential pullback. But if we scroll all the way back on the weekly chart, this yellow line at 4.2 is a technical weekly gap fill. So what we might see early on tomorrow is a potential continuation move in yields up to this 4.2, but then I do think we get a pullback at least back down to this 4.03 mark. Nevertheless, even if we don't get a move to this 4 point, I do think we see a pullback in yields, potentially down to this original support zone at the very least. And that's at the very least. So I do think these markets can continue a potential bounce if the yields continue to pull back, just due to how extended they are on all major time frames. If we look at the US 2-year yield, let me just pull up that chart. So the US 2-year yield is also extremely interesting because you are hitting that same parallel channel of resistance, just hovering up above that level. Now, again, tomorrow, if we confirm above this 4.53 level, or sorry, above this previous high here, today's high, then that will signify another potential breakout in yields. But again, look at the extension move in the US 2-year yield. And this is the rate that the federal fund rate needs to get to. But I do think we're close to not a permanent high on yields, but a short-term high, enough for a potential pullback. And the key trend line I'm watching is this trend line over here, connecting your major pivot to your major pivot to your major pivot zone over here. If we can break that, then you likely see a move back down to 4.36%, which would certainly weaken the dollar or soften the dollar in the near term, and it would find some reprieve in the markets. Now let's just flip back to the SPY, and this is why I think the SPY is intriguing, because the SPY has not made new lows despite yields making new highs. And you would most likely assume the correlation to be that the dollar would also make new highs alongside with yields making new highs. And the fact that we haven't seen new dollar highs is, again, that's why I'm assuming it's relative weakness, because generally the two asset classes move in tandem. If we simply draw a trend line over here, you can see that we are coming close to some resistance. If we get a couple more days of consolidation and then you test this resistance, it is going to be a pretty big level to break. But nonetheless, even a move up to this 378, 377 mark would lift our day trade positions pretty substantially. And I do think that considering that the yields have surged tremendously once again, and the fact that the markets didn't react as poorly as one would have expected, is relative strength for the S&P 500. Now, obviously with earnings, there's a wild amount of earnings on the horizon. Tesla did report today. We are shorting Tesla. It's teetering on this, basically this mega head and shoulders pattern. You have not confirmed the technical downside break. You did close on a weekly basis, so it does favor a move down. But Tesla is once again, it missed on its revenue, but it still has great free cash flow. Their earnings call is, I believe, at 5:30 p.m., so in about 22 minutes. So the stock potentially could move a little bit more based off of what Elon says. But nonetheless, it was a pretty bleak report. It wasn't really that market moving. You had a little bit of a downtick, uptick, but relatively kind of flat. You're down a couple points on Tesla. So it shouldn't impact the markets tremendously unless something changes in the guidance, in the forward guidance call that we're about to have in about 20 minutes. Let's just take a look at the QQQ. So the QQQ basically, again, is still holding, is just trying to basically break out of this downsloping trend line. Yesterday you peaked above it and failed to confirm above it. Today you peaked above it again, failed to close above it once again, but you're right on that level, and the more times you touch this trend line, the weaker it gets, so it does favor a potential move up. I still think we get a move to this 279.66. It's certainly one of those aspects that are also showing relative strength, even though yields are surging. So one would assume that the NASDAQ, because they're highly levered tech plays, they are generally more yield sensitive, and considering the NASDAQ did not sell off more despite yield surging, is again showing relative strength. Let's take a look at oil. Oil is basically retracing back to this breakdown zone. I still think oil is going to be heading much lower to this gap fill around 79 and then potentially 75 bucks. But again, this is pretty much a standard retrace. When you break a key level, you often retrace to it. You are closing basically just slightly above it today, but nonetheless, you're still at that technical resistance. Obviously, we did pick up a natural gas trade. Let me just pull up the natural gas chart. So we're going long natural gas via the BOIL. I telegraphed this play yesterday when I said if we see another move down in natural gas, I would likely consider going long and pick up some BOIL, which is what we did today. We're slightly down on that trade, but when you have natural gas now falling 1, 2, 3, 4, 5, 6, 7, 8 weeks in a row, that is into massive technical support, you can see over here, There could be a little bit more downside all the way down to this 533, but these are the levels that we start accumulating natural gas because this asset is certainly ferocious and can move. Where I think natural gas retraces to is this 665, so it's about a 12% move from our current level, which would mean our Boyle position increases by about 24%. So naturally, I would expect a technical retrace. Again, this week is options X, so our trades may not hit the levels this week. We may have to wait until the options expiration is completed, which is Friday, before some of these trades really start to bounce around. But nonetheless, I do think a lot of people are assuming natural gas is going to have a lot more downside and piling on the puts. Reason being is you've triggered this break over here, this key level of support. But one of the reasons why I would never short this triggering that level is because you had 8 weeks down in a row. The fact that you're now coming into massive support on an extended down move in an asset class that is still highly, highly needed in the economy and in Europe, natural gas is poised for a mean reversion technical bounce in the near term. Let's just take a look at gold. Gold was slaughtered again today, and why gold was slaughtered was because of the US dollar and yields. Nonetheless, despite the yields making new highs, gold still did not take out these lows over here, so that's slightly a little bit positive for gold, but it's nonetheless, it's breaking key support levels. Gold is now, there's a high probability move that gold can come test the low end of this range at around 1555, 1556, give or take. This is a down-sloping range, so if gold starts to consolidate sideways, that means that the move is going to head lower on the range. Let's just take a look at silver. Silver also took a hit today, but still holding key support. You do not want to see a close below this key trend line over here. If you see a close below that trend line, then this is probably going to be a failed move on silver, which likely sends it down to this 1730 level, or even this upsloping parallel channel. If we flip to the weekly chart, you can see the power of this channel over here, connecting a 2008 pivot to a 2018, 2019, your pre-COVID freakout, and that could be the level that silver is waiting to retrace to. So let's just take it day by day. I still like silver. I still like how depressed it is. It's only a matter of time before the metals get a little bit of a mean reversion. It's still obviously going to have to coincide with the US dollar pulling back. Let me see if there's anything. I could touch base on Bitcoin quickly. There's not really much price action on Bitcoin to discuss. Bitcoin is still trading below this downsloping trend line. So the longer Bitcoin takes to break out of that trend line, the more it favors a downside move. But considering the volatile price action in the indices like the S&P, the dollar, the yield market, it's really surprising that Bitcoin hasn't made a move lower, which is kind of a reason why I'm favoring still maybe a potential move up in Bitcoin before it has its inevitable big move to the downside. And it is showing a little bit of relative strength in comparison to the S&P 500 and the Nasdaq, considering the S&P and Nasdaq have fallen substantially in the last, basically 2 weeks, and Bitcoin hasn't really moved from this sideways range, is a little bit of a positive for the Bitcoin maximalists out there. Obviously, Bitcoin is at a bigger technical level. It's at a technical level from the 2017 highs. So we're talking about a 5-year level of support, as opposed to the S&P and the Nasdaq are only at about I think a 16-month level of support. So a 5-year level of support is much stronger than a 16-month. So that's probably why Bitcoin hasn't been reacting as volatile. But I do think we're going to see some price action here in Bitcoin. Maybe it coincides with Friday's move, but we'll just have to continue to wait and see how that progresses. Let's just touch base on a new position we picked up via the swing trade today. Alcoa was making this bullish consolidation. It did have earnings today, which it missed on substantially. But I still like Alcoa as a beautiful, even if it's a long-term position that you tuck away. Alcoa had a pretty big, tremendous drop in the on earnings in the aftermarket. But considering that you had this bullish pattern taking place and now Alcoa's retraced, filled the technical gap to the downside, I still think Alcoa can make a move up if aluminum makes a move up as well. So again, Alcoa was making this bull flag consolidation. I was close to buying it, but again, earnings are risky. Glad we didn't. We waited. We picked it up at the low, and we filled this key technical gap. Can Alcoa go a little bit lower? It certainly can, but when we picked it up at an 11.5% discount from when it was just trading to today, that's a pretty big level. And when you look at this level of support, there's tons of volume that have been traded in here, and lots of people have accumulated on this bullish formation pattern, and it's going to take a mega flush to flush all of that price action out. But we have our ad levels. Can Alcoa go lower? Yes, it can. It can go down to 30, it can go down to 29.44, it can even go down to this 27. But these are big critical levels that I do think will eventually be a great buying opportunity if we get there. Let's just see if we can touch base on anything else. Let me pull up the Tesla chart again to see if there's any change in the price action. Basically, no change in Tesla's price action there. A couple of the trades we are holding overnight, EXPEV. If we flip to the 10-minute intraday chart, EXPV again is one of those electric vehicles that are completely oversold. Considering Tesla did not really crap the bed too much, I still think XPEV gets a beautiful technical bounce. I mean, we could see a mean reversion bounce in this all the way back up to $10, which would be a tremendous gain. And it is a day trade position, which I'm holding on. I do like the fact that we saw this beautiful bullish engulfing reversal candle on the hourly chart on volume. So that to me signifies that we should see more upside tomorrow on XPEV. And obviously, if the dollar surges, it's going to hit this China play pretty hard. But considering the dollar's at resistance, the yields are at resistance, these stocks are oversold, it does favor a potential technical bounce. At the minimum, I think we get a retrace back to this 868 level, this massive technical gap. But you can see on the chart, there's so many technical gaps on this chart. And to me, that is just screaming a potential mean reversion technical bounce to fill those technical gaps to the upside. Let's just take a look to see if the IWM was really weak today. It was the weakest indice out of all of them, which is the small caps. You can see that the IWM was showing the most relative strength by breaking out of this downsloping trend line. It clearly hit resistance. You can see this pivot going back all the way to June, this wide range red bar. It tagged that, reversed, closed off of it, and failed to basically confirm below or confirm above this channel. Now, you did leave a technical gap to the upside, but you also have a technical gap to the downside. So in my opinion, probably a move on the IWM happens to the downside first before it happens to the upside, considering that you've now closed back below this downsloping trend line. So small caps could be under pressure tomorrow, but let's just continue to watch and see. If the dollar pulls back, they will certainly catch a little bit of a bid and a rip to the upside. But again, let's just continue to monitor all the indices, the dollar, the yields, and we'll see how things shape up. That being said, please give this video a big like down below, and we'll see you